Welcome to today's video, where we'll explore the world of index funds and how you can make money through passive investing. Index funds have gained popularity over the years, thanks to their low fees, diversification, and long-term growth potential. If you're interested in building wealth without the hassle of picking individual stocks, index funds could be a great option for you. So, let's dive in and learn how to make money with index funds. Way 1. Understand what index funds are. First, let's start with understanding what index funds are and how they work. Index funds are a type of mutual fund or exchange-traded fund, ETF, designed to track a specific market index, such as the S&P 500 or the Nasdaq Composite. The main goal of an index fund is to replicate the performance of its underlying index by holding the same stocks or assets in the same proportions as the index. By doing so, investors can achieve the same returns as the market index, minus the fund's fees. There are several benefits to investing in index funds. One of the main advantages is diversification. Since index funds hold a broad range of assets from their respective market indices, you are automatically diversified across a large number of stocks or other assets. This can help reduce the risks associated with investing in individual stocks. Another significant benefit of index funds is their low fees. Since they're passively managed, meaning they simply track an index rather than actively picking stocks, index funds typically have lower operating expenses than actively managed funds. This means that more of your investment goes towards growing your wealth, rather than being eaten away by high fees. Finally, the passive management approach of index funds allows investors to potentially benefit from the overall growth of the market without having to worry about constantly monitoring and adjusting their portfolio. This can make index funds an attractive option for investors who don't have the time or expertise to actively manage their investments. Way 2. Choose the right index funds for your portfolio. Next, let's talk about how to choose the right index funds for your investment portfolio. Selecting the right index funds for your portfolio is an important step in making money through these investments. Here are some tips to help you choose the best index funds for your needs. First, consider your investment goals. Are you looking to generate income, grow your capital, or both? Different index funds track different market indices, and each can offer varying returns and levels of risk. For example, if you're focused on long-term capital growth, you might consider an index fund that tracks the S&P 500 or total stock market index. If you're looking for income, you may opt for an index fund that focuses on dividend-paying stocks. Next, assess your risk tolerance. Index funds can vary in terms of risk, depending on the market index they track and the types of assets they hold. Generally, index funds that track larger, more established companies are considered lower risk, while those that focus on smaller companies or specific sectors may carry higher risk. Make sure to select an index fund that aligns with your risk tolerance and investment goals. Consider your investment time horizon. Some index funds may be more suitable for short-term investing, while others are better suited for long-term investing. Make sure the index funds you choose align with your time horizon and overall investment strategy. Finally, it's crucial to research and compare different index funds before investing. Look at factors such as their historical performance, fees, and the market index they track. Also, consider the reputation and track record of the fund provider. By comparing various index funds, you can make a more informed decision and choose the ones that best meet your needs. By carefully selecting the right index funds for your portfolio, you'll be well on your way to making money through these investments. Way 3. Dollar cost averaging. One popular strategy for investing in index funds is dollar cost averaging. Dollar cost averaging is a tried and tested investment strategy that involves consistently investing a fixed amount of money at regular intervals, regardless of market conditions. By employing this approach with index funds, you can potentially reduce the impact of market volatility and benefit from long-term growth. The concept of dollar cost averaging is simple. Instead of investing a lump sum all at once, you invest smaller amounts over time. This way, you purchase more shares when prices are low and fewer shares when prices are high, effectively averaging out the cost per share over time. This approach can help reduce the risk of poor market timing and mitigate the effects of short-term market fluctuations. Here are some tips for implementing a dollar cost averaging strategy with index funds. 1. Determine your investment amount and frequency. Decide how much money you want to invest and how often you will make those investments. This could be monthly, quarterly, or at another interval that works best for you. The key is to be consistent and stick to your plan. 2. Automate your investments. To make dollar cost averaging more convenient and ensure you stay consistent, consider setting up automatic investments through your brokerage account. This will automatically invest your predetermined amount at your chosen frequency, without you having to take any action. 3. Stay disciplined and patient. Dollar cost averaging is a long-term strategy that requires discipline and patience. Stick to your plan and resist the urge to change your investment amount or frequency based on short-term market movements. Over time, the benefits of dollar cost averaging can become more evident as you reduce the impact of market volatility on your portfolio. By implementing a dollar cost averaging strategy with index funds, you can potentially improve your returns, manage risk, and grow your wealth over time. Way 4. Reinvest dividends. Another way to make money with index funds is by reinvesting dividends. Dividends are payments made by companies to their shareholders as a way to distribute a portion of their earnings. Many index funds hold dividend-paying stocks, which means that, as an investor in those funds, you'll likely receive dividend payments periodically. Reinvesting dividends is a powerful strategy to grow your investment over time. Instead of taking the dividend payments as cash, you can choose to reinvest them by purchasing more shares of the index fund. This approach allows you to take advantage of compound interest, as your reinvested dividends will generate additional dividends in the future, leading to exponential growth in your investment. Here are some tips for setting up automatic dividend reinvestment with your investment account. 1. Check if your brokerage offers dividend reinvestment plans, DRIPs. Many brokerages offer DRIPs that automatically reinvest dividends into more shares of the index fund. Ensure that your brokerage provides this service, as not all do. 2. Enroll in the DRIP. If your brokerage offers a DRIP, follow their guidelines to enroll your index funds in the plan. This may involve filling out a form or adjusting your account settings online. 3. Monitor your investment. After you've set up automatic dividend reinvestment, make sure to regularly review your account statements to ensure that dividends are being reinvested as expected. This will also help you track the growth of your investment over time. By reinvesting dividends, you can maximize the potential returns of your index funds and accelerate the growth of your investment portfolio. Way 5. Take advantage of tax-advantaged accounts. Maximize your earnings by utilizing tax-advantaged accounts when investing in index funds. Tax-advantaged accounts, like individual retirement accounts, IRAs, and 401k plans, can help you make the most of your index fund investments by offering tax benefits that can boost your overall returns. The benefits of using tax-advantaged accounts include: 1. Tax-deferred growth. Investments in traditional IRAs and 401ks grow tax-deferred, meaning you won't have to pay taxes on your earnings until you withdraw the funds during retirement. This allows your investments to compound more effectively over time. 2. Tax-free growth. If you opt for a Roth IRA or Roth 401k, your investments grow tax-free. You contribute after-tax dollars, and qualified withdrawals during retirement are completely tax-free. This can be especially advantageous if you expect to be in a higher tax bracket in the future. Now, let's briefly discuss the differences between traditional and Roth accounts and how they affect your index fund investments. 1. Traditional accounts. Contributions to traditional IRAs and 401ks are made with pre-tax dollars, which can reduce your taxable income for the year. However, you'll have to pay taxes on the withdrawals during retirement, and there are required minimum distributions, RMDs, starting at age 72. 2. Roth accounts. Contributions to Roth IRAs and Roth 401ks are made with after-tax dollars, so there's no upfront tax deduction. However, as mentioned earlier, qualified withdrawals during retirement are tax-free, and there are no RMDs for Roth IRAs. By investing in index funds through tax-advantaged accounts, you can take advantage of tax benefits that can increase the overall returns on your investments and help you grow your wealth more efficiently. Way 6. Stay the course and be patient. Patience is key when it comes to making money with index funds. One of the most important factors in making money with index funds is having patience and maintaining a long-term perspective. Index funds are designed to follow the overall market, and historically, the stock market has shown a tendency to rise over long periods of time. Short-term market fluctuations can be nerve-wracking, but reacting to them emotionally can lead to poor investment decisions. Instead, focus on the following tips to stay disciplined and keep your eyes on your long-term investment goals. 1. Develop a plan. Create a solid investment plan that outlines your goals, risk tolerance, and time horizon. This plan will help you make informed decisions and avoid reacting impulsively to market changes. 2. Regularly review your portfolio. Review your portfolio periodically, but not too frequently, to ensure your investments are still aligned with your goals. This can help you avoid the temptation to make hasty decisions based on short-term market events. 3. Diversify your investments. Diversification can help reduce risk and smooth out the returns of your portfolio. While index funds offer built-in diversification, it's still important to diversify across different asset classes, such as stocks, bonds, and real estate. 4. Keep emotions in check. It's natural to feel anxious when markets are volatile, but try to stay calm and focus on your long-term objectives. Remember that market fluctuations are a normal part of investing, and sticking to your plan will likely benefit you in the long run. By staying patient, maintaining a long-term perspective, and not reacting to short-term market fluctuations, you can maximize your potential for success with index funds and build wealth over time. Index funds offer a simple and effective way to grow your wealth over the long term. By understanding how index funds work, choosing the right funds for your portfolio, and employing smart investment strategies like dollar cost averaging and dividend reinvestment, you can set yourself up for financial success. Remember, patience and discipline are crucial when it comes to investing in index funds, so stay the course and let the power of compounding do its magic. Thanks for watching, and don't forget to like, comment, and subscribe for more content on personal finance and investing.